Good morning, everyone. Bonjour tout le monde. It's a great pleasure that I'm hosting my very first webinar, so please indulge me if I'm moving too much, looking left, right, and center, and everywhere I'm not supposed to be looking. So the topic today is what structure is right for your farm business. I invite your questions. I'll see them pop up. I'll try to address them best as I can at the end of the show. So here we go. So first, Investors Group is the company I work with, and they were very keen on putting these disclaimer here. So I work with Investors Group, and the information I'm going to share with you today is very general in nature. It is not specific to your own situation, and obviously before you do any sort of move based on our conversation today, I would strongly recommend that you speak with your own personal advisors, be your financial planners, your accountants, your lawyers. I think it's a great thing to do. So here's a quick overview of what we'll be chatting about today. Okay, we'll be looking at different structures. Simply put, sole proprietorship or partnership, corporation or multiple corporations. We'll look at various timing factors. When should you make the change from sole proprietorship to corporations or multiple corporations? We'll look at the cost of doing these, the liabilities, taxation issues. We'll spend a bit of time on structure. For self-employed people, whether you're farmers or regular business people operating a non-farm business, structure is very key in terms of minimizing your taxes and ensuring that your business runs very smoothly. There's also some very interesting tax planning opportunities as well available to you that you won't not normally be able to do as a sole proprietor. And we'll look at some very key details that you need to take a look down. Okay? So we'll just take a look here at where things are at. So here's a very, very simple picture about what business structures are. And I just put three of them here: sole proprietor or partnership, single corporation, or multiple corporation. So let's spend a few minutes on this. So sole proprietor is likely the default setting of any business owner. You start off as a business, whether it's a farming business or any type of business. You just get into business, you sell something, pay your costs, and hopefully you've made a profit at it. That's your business. That's the genesis of all business. So it could be as simple as that, you had a crop, you brought the crop in, you sold it, and net of your expenses, you made a profit. Maybe you had, a calf when you were young. Your father said, here's a calf, raise it and sell it and see if you make some money at it. That's the start of a business. Now, as you progress in that business, it gets bigger. You make more sales. You have more farm receipts. You have bigger crops. You have bigger herds. And that will, in turn, give you bigger profits. The key about a sole proprietorship is that there is no distinction between yourself and your business, yourself and the farm. It is the same thing. So you do not file a separate tax return or anything like that. It's basically, this is what I do. Okay. If you choose to go into a corporation, you essentially create another person. So there is yourself, and then there's your business. And the two are completely different entities. And if you create multiple corporations, obviously, then there's yourself and company A and a holding company, a family trust, and there can be multiple stuff in there. Okay? So this is what we're trying to figure out. The key thing, and the topic we'll be addressing specifically today, is that when does one move from being a sole proprietor to a corporation? And there's many different things that you can think of, and we'll address those in just saying what's important here. What do we need to do? So here we go. Among the different factors to consider in starting your business. And just as an aside, I was born and raised on a farm. We had a poultry farm in Alexandria near Ontario, eastern Ontario, and my father went through all of this process, starting from a sole proprietorship to incorporating to multiple corporations. So not only do I know this personally from a professional perspective, I also know it personally from being down on the farm. So I might be able to give you a little bit more insight about this. So when does one incorporate? So we look from a time horizon perspective. This whole thing about incorporating, let's be real, it is strictly, or let's say strictly, mostly driven by taxes. Mostly driven by tax. And what drives the tax factors are different things that may happen during your business itself. Okay, so let's start off, for example, and you'll see from these slides here, I've come up with this simple progress. Essentially, is that there are two columns. What you see in white are essentially the sole proprietor issues, and on the blue side are the corporate issues. And you'll see that going through the different slides, that there's a two-column type of situation here. So when should you not incorporate? It's probably a good time to start. Okay. Well, fundamentally, if you need all the business that you generate in your farm, you do not need to incorporate. By that I mean, say that you make $50,000 a year of sales, and it costs you $45,000 a year to operate, and you make a $5,000 profit. You don't need to incorporate because you do not have much of a tax issue. In fact, you don't have much of a business, if I can be so blunt, because you've made 50 grand, you've spent 45, you made a $5,000 profit. Now, if later on, as you keep going and you're making $100,000 a year, and you're now spending 75 and you're making 25,000 profit, you still don't need to incorporate. There's not enough retained earnings in your corporation to be sure that you have enough assets worth protecting or hiding from taxes inside the corporation. Okay. As well, if we go the other way and you're in business and your business is not very profitable, especially in the early years where you have a lot of expenses, for example, you had to buy the farm, you had to buy quota, or you increased the size of your land holdings, and you're actually running at a deficit, then you do not need to incorporate. And the reason for that is that the losses that you have can be deducted against any other income that you may have. So again, something that is difficult to do with a corporation. The other thing too at incorporating, the third point on the bullet, is there's not much point incorporating, go through all the hassle, the expenses, and the whole rigmarole of incorporating if you're not planning on being on business very long. So again, the corporation, it should be viewed as something that is to be entered to very deliberately, and you would do that when you're looking at being in business for a while, the business is going well, you have solid profits, and you're looking to hide some of this money from income tax. Okay? That's when you should be looking at becoming a corporation. So on the blue box, when should we look at incorporating? Well, the simple rule of thumb is that you run a business, you're a sole proprietor, or you're in a partnership, and your profit. And by profit, let's be very clear, it's the money you made after you've paid everything. So your business expense, what you took on to live, if you drew money out, if you paid yourself a salary, or just whatever you lived on, if you have, let's say, an excess of $75,000 of profit left in your corporation, then you're starting to be in a position that you may want to look into incorporating in order to reduce your taxes. And I would submit, if you've had a particularly good year and you've made over $75,000, but it was truly a good year, it was not a run-of-the-mill. You had extraordinary sales, or the weather was particularly good, or the price was very good, and you were the only guy on the street or in the county that actually brought in a crop. Maybe that's the year you say, I need to incorporate. I made $120,000 net profit this year. Well, let's see if that's sustainable. Now, you would know this better than me, but that's what we're trying to determine. Is this something that's happening all the time? So if we move on to the next point, the administration cost. Sometimes people ask, it's like, is it expensive to incorporate? And the short answer is yes, there are costs involved. The sole proprietorship is the easiest structure there is. It's basically you. You do your own personal tax return, and the personal tax return and the business tax return are the same thing. You don't have to file a separate tax return. There is nothing different about you being in business getting a paycheck or you being in business and getting a profit. It's the same basic thing. You just report your income, take away your expenses, you have net business income. That essentially is your taxable income personally, and away you go. So there is no administrative cost other than maybe, you probably will use an accountant as well, even if it's a personal or a sole proprietorship, but it's not very complicated. If you're looking at setting up a corporation, there are costs involved. Okay? First and foremost, you have to set up the corporation. So there are legal costs of setting that up. You have to set up the corporation. You have to prepare annual shareholder meetings. And to tell you there's costs, yes, there's going to be, because you've just hired an accountant and you've just hired a lawyer. Accountants and lawyers are great people, but they do not work for free. They will charge you. And these people tend to charge by the hour. This takes some time, so you'll be expecting a bill. Okay? Bottom line, to make a simple number, to set up a corporation, you can do it yourself online for a moderate fee. It's not something I would recommend because it's something that's pretty serious. It's involving your business, your livelihood, so you may want to have a professional helping you do that. Setting up a corporation, the structure from a legal perspective, probably looking at $1,000 to $2,000 to set up, and the ongoing costs from an accounting perspective, doing your corporate tax return, the bookkeeping and the like, we'll be looking at $2,000 to $3,000 a year, possibly more, possibly less, depending on your accountant, and also how complex your business is. If yours is a multi-million-dollar business when you decide to incorporate, obviously the costs of running that corporation will be much higher than if you have a very simple farm structure. As well, on the administrative cost, I wouldn't even call it administrative cost, but there is a cost in the sense that there are lots for you to start understanding if you do decide to go to the corporation route. You're going to have to figure out, how does this corporation work? Truly understand that you've created a new legal person, that this corporation needs to be fed. You need to learn about it, how to use it to your full advantage. One simply does not create a corporation out of a whim. It's done truly because there is a need for that corporation. And the need for that corporation, in many cases, will be determined by your professional advisors. They will make the recommendation to you saying, given your circumstances and your personal situation and what your plans are for your corporation, for your business, you may look at incorporating. And that decision could actually take years to come to fruition. You start thinking about it, looking at it, and by the time you actually get done, some time has elapsed. Okay. So if we take a look at a key reason that people incorporate, it's because of liability. When you're sole business owner, you're it. Okay? All of your assets are exposed to creditors. If your business is successful, you're going to make some money, and that money accumulates in your own name, and you'll have RSPs and tax-free savings account and non-registered investments, and you'll have investments perhaps in your children's name, the education plan, so you'll have a lot of assets. Now, if business goes south, those assets are available to your creditor. There is no distinction between John Smith and John Smith Farms if you're not incorporated. When you incorporate, as I said earlier, you create a separate person, and that separate person, the corporation, has limited liability. So that is a very, very strong factor for a lot of people, is the liability aspects of incorporating. As well, sometimes in a partnership, same concept applies. A partnership are 2 or 3 or 4 sole proprietors who have gotten together to work. But everyone is responsible for everybody else. That means, let's say there's 3 partners, and 2 are very diligent and they do everything by the book, but there's one of the partners that is not so good, and he has committed the partnership to a project or an endeavor or a loan. Everybody is liable for that mistake, for lack of a better word. So if one party is negligent, everybody's exposed. Again, in a corporation, those are issues that simply go away. Okay? So a corporation is a separate legal entity. So there is a complete distinction between John Smith and John Smith Farm, Inc. And that is very, very important from a liability perspective, particularly if you're involved in type of industries or type of farming that may expose you to lawsuits, such as environmental issues, or if you're risk from farm accidents. Also important to know is that when you create a corporation, it doesn't automatically mean that you'll get everything that you want, because the banks and other creditors will often ask for personal guarantees. So personal guarantees sort of blurs the line to a certain extent, in that you have a corporate asset, a corporate debt, but there's personal guarantees behind it. Banks will often ask to have as much guarantees as possible so that they have protected as much as possible. So Key point on corporations from a liability perspective is that the liabilities are separate. Sole proprietorships, everything is exposed. In a corporation, we have a protection of your personal assets. And that's a very, very important point, especially later on in your farming career when you start building assets. If ever there was an issue, everything could be lost with an unfortunate accident or lawsuit or the like, whereas in a corporation, you might have been able to protect some personal assets in a better fashion. Taxation. So this is the bread and butter of the whole thing about incorporating, is what about taxation? How is this all going to be working out? Well, from a taxation perspective, let's start again with the sole proprietor. It's a simple process. The more you make, the more you pay taxes. In Canada, we have graduated tax rates, so the more money you make, the more taxes you pay. To explain a little bit more, if you have farm income, that's your gross sales, your gross receipts, or whatever you want. Those are your income. From that, you get to write off a whole bunch of stuff. Okay, your cost of goods. If you're in a crop business, you get to write off your seeds. You get to write off the manpower that you use, the people that you work with, that you pay third-party salaries. You might be able to reduce your taxation by including, for example, a spouse and paying a spouse a salary, paying some children a salary. So you're trying to minimize your net business income. And it truly is the net business or the net farm income that will be taxed in your hands personally if you are a sole proprietor. Ballpark, to make a simple numbers, from 0 to 45,000 of net business income or net farm income, the tax rate is about 21%. I'm using Ontario rates here. I have those more memorized, but they are similar like that in every province. From 45 to about 85,000 of net income, you're in about a 33% tax bracket. So essentially, a third of what you make at that point is going to income tax. And then from 85,000 to about 125, you're starting to hit the 40% tax bracket. And over 125,000, you're probably in the 45, in some provinces 48, 49% will go to taxes. So we can see that if you have a successful farm and your income hits to be the net income, again, net of your expenses, hits triple digits, you're going to have a significant tax bill to pay. Okay? So there is going to be significant taxes to pay. As well, there could be extraordinary events. You sell a piece of land, or you sell some quota, or you sell things like that. If they're personally held, you could push you into a higher tax bracket. We'll come into some capital gains exemption in a minute, but there is some ways that your income tax bill could go through the roof. Okay. Now, again, the whole point being a sole proprietorship is you want to keep your your income down as low as possible, and the way to do that is to come up with different deductions and the like. With a corporation, the blue box, the tax rate in a corporation, especially for the small business income, is significantly lower inside a corporation than it is personally. We're looking at 12 to 19%, as opposed to, you recall, on the personal side, 20, 33, and 40% plus. So to make a simple number, if we use 15% corporate tax rate versus 45% personal tax rate, there's a 30-point difference between the two. And again, I'm just making a very simple example. If your net farm income was $500,000, that means after you've paid everybody, your expenses and everything else, the farm netted $500,000. Personally versus corporately, the marginal tax rate goes from 45% to 15%. That is a 30% difference. And to make it very blunt, 30% on $500,000 is $150,000 less income tax to be paid. $150,000 less income tax to be paid, even if you have to pay a lawyer and accountant a few $1,000s every year to set up this, you're certainly very well ahead given the kind of income you're now making in the farm. Okay? And because you have less taxes that went out. It means there's more money left into the farm to carry on with the business of the farm. And that becomes very, very important. Because the more money remains in the farm, less went out to income tax, well, you don't have to borrow as much, or you can pay off debts faster, you can expand the farm, you can do a whole bunch of stuff because there's more money in the corporation. As well, that money in the corporation will grow. So that money grows, and it makes you richer. Call me crazy, but that's not a bad thing. So fundamentally, if you have a successful farm, and you are a sole proprietor, you make some money, you pay taxes on it, and whatever's left is still in your personal hands, and that grows, and you're taxed on that as well. So even the net is still growing on a taxable basis. Now you can mitigate that by using some of those proceeds and buying RSPs and tax-free savings account. If you have young children, set up education plans. You could look at insurance. There's ways you can reduce your personal income tax on those incomes. Those options are sometimes not available inside a corporation. There's no such thing as a corporate RSP, so that money grows inside the corporation on a taxable basis. But what we're trying to do is to keep as much money into your hands as possible. And the way to do that is to minimize your taxes. So again, on the personal side, you have net income, you pay taxes, whatever's left is retained earnings, it's money that you have left in your personal name. If we have money inside a corporation, you're going to end up with more money inside the corporation, which grows, which generates more income, or is this money that you can use for different things. And the great thing is that it doesn't end at retirement or when you stop farming. The money is still within the corporation, money that you can use to do whatever you want for the corporation. Okay? So here's a very simple example of this. Okay? And I'm just going to go to this one here. Quick case study on the whole farm situation with personal and corporate taxation. Say the farm has a $250,000 loan, and obviously we want to pay this thing off eventually. So if the first person is incorporated and has a tax rate of 15.5%, and then on the other side, owner B is a sole proprietor who is on a 40% tax rate, what's the difference? Well, the numbers are pretty clear. The farmer who's incorporated will need to generate a profit of just under $300,000 of profit, pay the 15% taxes on it, and then he's left with $250,000 net of tax to pay the farm loan. Now, if you are sole proprietor, you're going to have to make well over $400,000 of income, net income, pay your taxes on it, to be left with $250,000 net to pay your taxes. So we can see clearly here that having money in the advantage of incorporating. Both farmers have a $250,000 debt. One farmer only needs to generate $300,000 worth of earnings to pay this debt, whereas the other farmer, same business, same everything, but different structure, needs to generate over $400,000 of net income to pay this same debt. So that gives you a pretty good idea of how much taxes becomes a key issue inside a corporation. And forget the $250,000 loan. Say you wanted to build a $250,000 asset within the farm to buy more land or to buy more quota. Same concept. You have to create less income to generate the same profit. So taxes truly become a key writing issue inside a corporation. Now, still with the corporation and the structure behind it, there's a lot of advantages that a corporation is allowed that individual people, sole proprietorship, is not allowed. And chief among those is the whole salary versus dividend. So essentially, when you take a look at your business, your farm, if you are a sole proprietor, you do not get yourself a true salary. You simply get whatever profit is left. So as the sole proprietor, you don't get dividends, you don't get salary, you simply get a profit. Salaries are something you pay to other people. So if you are self-employed, sole proprietor, you can pay a salary to a third party, but that money has left the building, right? So if you pay, for example, your key person $50,000 a year, well, that $50,000 a year has left your farm, has left your pocket, and is now in the other guy's pocket. That's the bad news. The good news, you got $50,000 worth of salary. Hopefully, you spent the 50 grand and you got somebody who helped you out all year. And you also get to write off that $50,000 salary against your farm income. So you only pay taxes on the difference. Something that can be done very clearly is that a lot of farms sole proprietorships, will pay a salary to a spouse. So a spouse, perfectly legitimate, you can pay a salary to a spouse, the business will get to write it off, and the money stays in the family. Because you paid it, like say John Smith paid it to Mary Smith, Mary's got the $50,000 salary, and that money stayed in the family. Yet John got to write it off. Now, if there is 3 children, and we paid a $10,000 salary to Peter, and $15,000 salary to Elizabeth, those children get that income. They can use that to pay for their schooling or whatnot, and John, the father, gets to write them off. Now the key thing is this, is that the salaries paid have to be reasonable. What do we mean by reasonable? Well, CRA, Canada Revenue Agency, Revenue Canada, are picky about this kind of stuff. Okay? For example, it would not be reasonable to pay a 6-year-old $15,000 a year for work done around the house. A 6-year-old, you probably would not pay your neighbor's 6-year-old kid $15,000 a year for work done around the farm. But if you have, for example, a 17-year-old who works all summer and every weekend on the farm, then it's reasonable to pay this person, $10,000, $15,000 a year because they put in the work. Same thing with the spouse. If the spouse has a full-time job working outside the home, outside the farm, it would not be reasonable to pay that non-farm working spouse, for lack of a better word, $100,000 a year. It would not be reasonable. Okay? Now, if that spouse works full-time on the farm, yes, it would be reasonable. Okay? The same thing applies as well with partnership agreements. You have to be reasonable within the partners that you allocate these incomes, these expenses among the partners. Okay? Now, here's the fun part. For corporations, okay, the same reasonable test applies to salaries. Okay? So again, if you've incorporated and you've got a 6-year-old son, the corporation cannot pay your 6-year-old son $50,000 a year salary. That would not be reasonable. What would be reasonable, though, is that if your son had shares in the corporation, you can pay dividends. And you don't have to worry if the payment of the dividend is reasonable or in line with the work performed. That is a key variation. Okay? And as well, from a tax perspective, once you're incorporated, one of the great debates, if you wish, among the financial planning and accounting businesses is, should the owner of the corporation receive a salary or receive a dividend? There's advantages to both, and I'll explain briefly here, but in a nutshell, say that you're a successful farm, you've incorporated, and you have paid yourself a $100,000 salary. The good news about the $100,000 salary is that that salary is an expense to the corporation, so it will reduce your corporate taxes. The bad news is that this salary is income to you as the farmer, as the shareholder of this corporation, and as salary it is taxed just as if it was farm income from your non-incorporation days. The first $45,000 is taxed at 20%. From 45 to 85, you're taxed about 33, and then 85 on, you're taxed at 45%. So there is this graduated tax rates that come into play. Now, if you pay yourself a dividend, say it's the same $100,000 dividend out of your corporation, the same thing applies. You still have graduated rates, but dividends are taxed at a much lower rate in your personal hands. The drawback, the company cannot claim a deduction for dividends paid. So the whole idea behind incorporating is a very simple one. Say you make $100,000 a year net farm income. And this $100,000 a year you earn through a sole proprietorship. You get $100,000 profit, you get it, you pay taxes on it, and away you go. If you incorporate and you take this same $100,000 income, you pay corporate taxes on it, 15%, and then you flow what's left directly out to you, and you pay yourself out a dividend, the amount of taxes you'll pay on the dividends plus the amount of taxes you paid in the corporation will be about the same amount of money that you would have paid had you received the money directly as a salary, directly as a sole proprietor. So to make it simple, if the whole money flows through the corporation and out back into your personal hands, there is no point in incorporating. You will pay about the same amount of taxes either way, either as a sole proprietor or as a corporate setup. So if you're going to pay the same amount of taxes on that $100,000, whether it's received personally or whether it's received through a corporation, you did an awful lot of work, spent an awful lot of money with lawyers and accountants and the upkeep cost for no true net difference. The whole point of setting up a corporation is to have money stay in the corporation and have that money work within the corporation to pay down debt, grow the business, and away from there. Okay? So that's a very important thing about having the corporation. Now, same thing with the salaries and dividends. The more people you have around you, spouse, children, you can sprinkle that money around, either as salary if you're sole proprietor or as dividends if you went the corporate route. And that makes things very, very interesting as well. Okay. Now, we'll get into a little bit more technical for a second here, but there is, when you take a look at a farm, there's a capital gain exemption. Capital gain right now is $750,000. It'll go to $800,000 in a few weeks. And that's per person. In a nutshell, again, same, you recall, the white side is the sole proprietor side and the blue is the corporate side. It is much easier to realize that capital gains exemption as a sole proprietor as it is through a corporation. So let's give you a bit of background on this whole capital gains exemption. Capital gains simply means that you've bought something that has appreciated, and when you sell it, you have to pay taxes on that profit. So for example, say that you bought a farm and you paid $100,000 for it, and you exploit the farm, you do really well at it, and one day it's worth $1.1 million, just to make it simple numbers here. So the value of the farm, the land, the quota, whatever it is, has gone up by $1 million. If you were to sell the farm at that point to a third party, that $1 million is a capital gain. You sell for $1.1 million, you paid $1 million for it. I'm assuming here that you did not put a dime into the business, that you did not reinvest. It's simply to the quota or the land value that went up in value. That $1 million is taxable. Now, that's a capital gain. Capital gains, 50% of the gain is tax-free, 50% of the gain is taxable. So in this case, you got a $1 million gain, $500,000 would be taxable. And then you add that to your income and you pay taxes. You can see it's going to be a fairly hefty tax bill. Now what's fun, what's really good, is that there are some tax privileges afforded to farms that a lot of other businesses do not have. Farms is this capital gains exemption. So in the example I just built, if this farm was sold now in 2013 for $1 million of net profit, the first $750,000 would not be taxable. That is a huge advantage. Now, if the farm was a partnership, say husband and wife, what's interesting then is that each is entitled to the $750,000. That's $1.5 million. So in this example, John and Mary Smith bought the farm for $100,000, sell it down the road for $1.1. They have $1 million of capital gain. It's tax-free. The $1.1 million goes into their pockets, net of tax. That's amazing. That is the whole point of having a farm go up in value, because, as we know, farmers do not have pension plans. The value of the farm increase is your pension plan. That's the whole point. Now, how do you use this? Okay. Well, we have to get into specific examples, and I'm loath to do this because everybody's situation is very different. But in a lot of cases, when people go from sole proprietorship to a corporation, we need to bring assets into the corporation, or we may choose not to. Okay? So for example, you have a business, it's doing quite well, you're making good money after your expenses, after you've paid your salaries and your expenses and everything else, and you're making consistently 6 figures, net farm income, 100,000, 200,000, 300,000, 500,000 a year, income that you really don't need for your lifestyle. Everything is looked after, your house is paid for, your kids' education is looked after, things are working out well. Yet, because you're sole proprietor and you're making this, $200,000, $300,000, $400,000 worth of income every year, you're paying a lot of taxes personally. So at that point, some of your advisors, your accountant in particular, may suggest to you that you strongly consider incorporating so that your farm income is taxed at the corporate levels that we saw earlier, as opposed to personal levels, which are much higher. So by incorporating your farm, same business, same everything, nothing has changed there. I mean, it's the same cows you get to go see, same fields you get to work on, same chickens whose eggs you got to pick every morning. But that business, same business, is now incorporated, means that the income that you generate is taxed at a lower rate. That's why you incorporate. Now, what you may want to do at that point is you have other assets. We're thinking land, your home, quota really comes out in particular. In a lot of cases, those assets will not be rolled into the corporation. And the reason we may not roll them into the corporation is to protect your capital gains exemption. Without going into too much detail here, but this capital gains exemption on farm property is only available personally. It is not available through the corporation. Now, the corporation has it, but only if you sell the shares of the corporation, not if the corporation sells the land or the quota, like an asset sale. So very different if you were to sell the farm personally and selling the farm once it's inside a corporate structure, there's a huge difference on the taxation of that sale based on who owns what and where it's owned. Again, just to build a simple example, if you have quota that has gone up by $1 million and you own it personally and you sell the quota to a third party, you will benefit from the capital gains exemption. If the quota was rolled into the corporation and your corporation sells the quota, the corporation does not get the capital gains exemption. The corporation will only get the capital gains exemption if you sell the shares of the business, shares of the farm, to a third party. So for a variety of reasons, the seller will want to sell the shares, but the buyer doesn't want to buy the shares, the buyer wants to buy the asset. Now, this format does not allow me to go into the full details of that, but suffice it to know that the capital gains exemption is an incredible deduction and one that should not be lost. So the whole structure of a corporation becomes very important in terms of how do we are able to settle this. So sometimes what has happened is people will have said, okay, I'm going to incorporate the business. We bought the farm 20, 30 years ago, and there were substantial gains in the farm. For example, land has appreciated, the quota has appreciated, and you want to claim the exemption. The thinking was many years ago is that maybe this capital gains exemption will go away, maybe the government will remove it, and I don't want to lose it. So for example, if we go back to the example of the John and Mary Smith farm that they bought for $100,000, now worth $1.1 million, they could incorporate that business and flip over the value of that property into their corporation. Now when they do that, they're going to trigger the $1 million capital gain. Because when you sell the assets from personal and you move them into the corporation, from a perspective of tax, this is a disposition. If you sold it to a third party, your corporation is a third party. So the $1 million of capital gain will be triggered when you make that sale. But then, since you're selling it personally to a corporation, you can claim your exemption. So that $1 million of appreciation, whether it's on the land, the quota, or what have you, is tax-free to you. And now the corporation gets this asset of $1.1 million, and it goes from there. Now, any further appreciation will not generate from this capital gains exemption. And what's interesting with the capital gains exemption is I don't think it's going away. And the reason I say that is it's going up to $800,000 in 2014, and then thereafter this will be indexed. So that means that every year this $800,000 grows. So there is something to be said, like, if you go back to John and Mary Smith, $800,000 each, that's $1.6 million, and say that inflation runs at 3% to make a simple number, 3% of $1.6 million, it's $48,000 a year of capital gains exemption being created. So for example, in 10 years from now, assuming current laws stay the same, it would not be impossible to think that for a couple, that your capital gains exemption on farm property could be $500,000 more in 2024 than it would be today. So $500,000 10 years out is nothing to sneeze at, and something that I would really want to keep handy and available. Just to touch on the home, a lot of farms have a homestead on the property. Bluntly speaking, I would never roll over the house into the corporation. The simple fact being is that the house, the personal residence, is always tax-free. So the personal home, if ever you sell it, when you sell the farm, it's a tax-free transaction. But if it was rolled into the corporation and sold, it's part of farm property and would become taxable. So not a good idea to roll in something that's already tax-free into something that could become taxable later on. Let's talk a little bit about multiple corporations. Now, the simplest thing about a multiple corporation is you have different corporations and they may have different purposes. A simple example, say that you have a farm that has a cash crop operation, and then you have another farm, same person, but you have a different business and you have milking cows. So you have dairy farm and you have a cash crop farm. If only for reporting purposes and the like, when you choose to make the decision to incorporate, you may decide to create two corporations to see just how well your dairy farm is doing and how well your cash crop business is going. So there's two sets of financials, so you can see how each one is doing. You can combine them into a holding corporation to see how both of them are doing together. So that's part of the reason, a simple reason that you would create multiple corporations is they have different business lines. And that way, if you were to sell, for example, the dairy farm, but you still want to retain the cash crop, the land, and the cash crop, and the equipment, and everything else that you use for that, then it's a very simple, it's easier to separate the two businesses because there is two separate corporations. But what I really want to go into when about multiple corporations, I go back to structure. And the most common structure that you will see in a farm is the one that's on the screen right now. Is where you have an operating company, a holding company, and a family trust. And the best way to describe that, and I'll use an example that I have it in a lot of my client bases, is the farm income comes into this operating company. And the reason we do that, as you recall, is to have the preferred tax rate, the 15% tax rate on the farm income inside the corporation, as opposed to the 45% tax rate that you would be faced if this money was received personally. So we'll call that the operating company, and that's where the money flows into. That's where the expenses are paid from, and basically it's the farm. That's where things are at right now. What's interesting is that if you create a holding company, you can take this holding company, and then you can flow your profits after you pay taxes on it, your net farm income, flow that from the operating company into the holding company, a separate corporation. And the reason you may want to do that is, first of all, to separate the assets from the operating and the holding company, strictly from a liability perspective. Again, if your business was very successful and you are starting to amass significant funds within the farm, those assets become available to creditors and become available in the case of a lawsuit. If you flip it into a holding company, it's removed from the operating company, and there's a greater degree of protection on those assets. Okay? Now, the main reason we create a holding company is that you can create or attach to this holding company a family trust. And a family trust, what's really fun about that is you can actually get money out of the family trust and put that in hands of beneficiaries. So let's give you a specific example. You have a farm, John and Mary Smith, let's go back to them, and the farm's making good money. The money's in the operating company, and say they've generated $200,000 net profit. Those profits are floating to the holding company, and those two kids, and I forget how I named them, I think it was Peter and Elizabeth here. Peter and Elizabeth are now 19 and 21, they're in university. University is expensive, there's tuition to pay. Maybe it's not in their hometown, they have to travel, there's an apartment to pay, there's the moving expenses and things like that. Well, what's interesting is that the holding company is owned by the family trust. And the family trust could decide that we're going to pay a dividend to the beneficiaries. So in the family trust, you could create it and have, let's say, for example, 4 beneficiaries, John and Mary, Peter and Elizabeth, mom and dad and the 2 kids. You could put other beneficiaries down in there if you want. For example, if John's parents are still around, you could put them down. You could put Mary's parents. You could put eventually grandchildren. If Elizabeth marries and has children, you could put grandchildren in there. So the family trust is a very supple tool that you can add a whole bunch of people to it. Let's go back to the simple one. $200,000 profit inside the holding company. Kids are in school. They're over 18, and this is the key point. For the family trust to work, the children have to be above 18 years of age. If you pay money out of a family trust to children who are less than 18, taxes, well, it's called a kiddie tax. You don't want to do that. The tax implications are completely destroyed. But the kids are over 18. They're adults. Say that you flow out a $40,000 dividend to each child. That child will have a $40,000 dividend income that year. Let's assume that's their only income. Didn't have a summer job or nothing like that. If you have $40,000 of dividend income, the amount of income tax you pay on that is about 0. In some provinces, like Ontario, you may have to pay a health care tax, but fundamentally, provincial and federal income tax is 0. 2 kids, $40,000 each, there's $80,000 that just came out of that corporation, tax-free. If John had taken money out of the operating company, it would have been paid out as a salary and fully taxable. He could have paid himself out as a dividend, less taxes, but then the farm doesn't get the deduction. Either way, if John flows out $40,000 out of the operating company, he doesn't get to keep $40,000. But if we flow the $40,000 from OpCo to HoldCo to the family trust, Peter, the son, who's 19, gets to keep the 40 grand. Now legally, it's his money. He can take this money and do whatever he wants. That's the part about being 18. John, the father, cannot tell Peter what to do with this money. But John is still Peter's father. So there is moral suasion, for lack of a better word here. And he can say to Peter, good, you've got $40,000. You get to pay your tuition fees, and you get to pay your way down to university and pay your apartment, and if you need a car and everything else. So the money has stayed in the family to pay some expenses. That money could also be used to pay for family trips. Could be used to pay for timeshare. That money could be used to pay for essentially anything the family needs. But the money flowed through the corporation, through the holding company, into the family trust, and the money is now in the kids' hands. And for a lot of people, as the kids get older, when they're 18 to, let's say, in a lot of cases, 22, 23, and sometimes 25, the kids are not financially independent at this point. So if we can flow money out of the farm into the kids' hands to pay for some expenses, that's a very smart way of using your corporation. Hence the importance of structure. And that's the whole point about incorporating. When should you go from not being incorporated to being incorporated, is because you may have the capacity of doing these types of dividend sprinkling, for lack of a better word, that a sole proprietorship cannot do. There is no easy way of taking money out of a sole proprietorship and putting in your kids' hands. It can't be done. It's a gift at that point, but it's also a gift made after tax. Whereas if we use the structure that's on the screen right now, by flipping the assets from different structures, we get the money out in a significantly lower tax rate. So for farms that have young children who say are, let's say, 10, 12 years old right now, this structure is premature. You can't use it at this point. But it's something that you may want to keep in mind that say, we've been farming for a few years, business is good, we're making good money, we see ourselves continuing to farm for many, many years. Not sure if the kids will take over the farm or not, but start thinking about this type of structure. You may want to have a quick chat about it with your accountant, with your financial planner, with your lawyer, and just to see if this type of structure would help you down the road to minimize taxes at the family level. So today your farm may not be in a position that you need to incorporate because your net farm income is not high enough to justify the cost of setting it up and the whole infrastructure of this, but you might see it down the road, like things are going up, the farm is increasing, we're paying down the debts, we have more and more profits every year, and then you can see that eventually you're going to be profitable. So what you may want to do is start looking at your incorporation, the holding company, and the family trust, so that eventually, when the children do reach 18, 19 plus, that the corporation is in place, that there are retained earnings inside the corporation. And remember from that slide earlier on the $250,000 loan, let's go back to it here for a second here. If we go back to the case study here, we had, what if the farm has a $250,000 loan? Well, let's say we wanted to build a $250,000 asset. Remember we said $300,000 corporate, over $400,000 on the sole proprietor. So if we're looking at building assets, the corporation will have greater ease in building those assets that can be later flowed out through the structure that we've put in place here into your children's hands, or your own hands for that matter, but we can flow money out. So hopefully by these little, this presentation on structure, we appreciate the true end game of incorporating. We save on taxes while the corporation is in effect, and more importantly, we're able to find ways of getting money out of the corporation in a very tax-friendly fashion. And I think that is something that's really worthwhile doing. Okay. Now, before we go into this whole incorporation thing, I call it look before you leap. There is a number of things that I didn't touch on, but that become very important. Incorporation date, corporate year-end, company name, directors, types of shares, things that we need to really put into perspective. I'll just touch on corporate year-end for a second here. If you're a cash crop farmer, you may not want to incorporate in your busiest time of the year. So for example, incorporating, we have a year-end in the spring or a year-end in the fall may not be the greatest time of the year because you'll need to get your year-end ready and you might be busy, so that the whole point of running those numbers, doing that, may not be timely. As well, from an income perspective, again, if you're a cash crop farmer, most of your income comes into the fall. So if you choose a year-end that is, let's say, August 31st, that might be a very good year-end for you because that year, your income hasn't come in yet. And all the income that comes into that fall will fall into the next calendar year, and you've effectively delayed taxation for a full year because you can choose not to have a year-end at calendar year-end, so not having a December 31st, but having a year-end, say, of August 31st. Directors, officers, you can name people to your corporation. Another quick way of splitting income is you can put spouses down as a director, and then they can be paid director's fees. So another way of moving money about. Okay. This concludes the formal part of the presentation. Hopefully you found this enjoyable and my head wasn't bopping too much and I was looking hopefully at you a little bit while I was reading my notes and everything else. I'm just going to scroll through here. There's some questions that people have put in and I'm just going to see about if I can help some people out here. One of the questions was addressing the tax implication of shutting down a corporation or drawing down capital reserves. Well, first of all, thank you, Vern, for your question. Appreciate it. Bluntly speaking, it's not an easy question. It depends a lot on your personal situation. But the tax implication of shutting down a corporation are important. They're big. And the reason is that a corporation, by its nature, does not have an end date. A corporation lives on forever. When you're sole proprietor, the business ends when the person dies. So if John Smith never incorporates, the business is deemed wound up when he dies. Now, if John incorporates and John dies, the corporation still exists. So John Smith Farm Inc. still exists even though John Smith died. If you choose to shut down a corporation, you have to divest everything out of the corporation. And when you do that, there's going to be some tax implications at two levels. There's going to be tax implications within the corporation as you sell assets or sell shares. So there's going to be some capital gains, there'll be some disposition. If you've depreciated some assets, there could be some recapture. But there's going to be taxes within the corporation. And then when you wind up the corporation, you're going to take those assets that are now in cash inside the corporation and move those assets out of the corporation into the person's hands. And there'll be another level of taxation there, because this money will flow out, again, salary or dividends, or you pay back money that you may have advanced to the corporation. Not impossible times that when you set up the corporation that the owner owned assets, rolled it into the corporation owed him money. So if you take money out, okay, you can take some of that money out on a tax-free basis. So again, Vern, great question, but it might be useful to talk to your accountant on this specifically. Okay. I'm going to the next question here with the few minutes that I have left. Tom is asking, what about corporate joint ventures and multiple or different year ends for each? I touched on that briefly. Yes, when you set up multiple corporations, knock yourself out. I mean, your accountant's going to love you and your lawyer even more. But if you set up 2 or 3 different corporations because you have 2 or 3 different businesses, that is a good thing to do. And you talk about corporate joint ventures, say that you have the cash crop farm, the cash crop part of your farm is with your brother and the dairy farm is with your sister, then yes, I would certainly have 2 corporations because there are different share ownerships in there. Okay, so that's something that's really worth doing and looking into it. And the different year ends, yes, different corporations can have different year ends. Now I'm looking at that question here, shares and asset, if the company is sued, are the shares available to settle the suit, excuse me. The owner has to declare bankruptcy. I'm reading this quickly here, but, oh, now it just went away. I like these questions things, they go up and back and forth. Okay, hard to read the question because it keeps changing here. Let me just see here. As a farm business, no, we're in the middle of the crazy because the input costs, yeah. Yeah, so again, different timing of the farm. Does it make sense, John is asking, does it make sense to incorporate a separate a farm that brings in more money than the farm itself, even though there is no income? Yeah, well, again, if I understand the question correctly, there's no point to incorporating if the farm makes no money. The reason you incorporate is to lower your taxation on your net farm income. So if the farm has no net income, incorporation will create no value. So there's no point in doing that, even though there's no tax problem yet. Again, scrolling quickly here to different questions here. Family trust. Steve likes this. He understands how family trusts work. That's good. Thank you, Steve. Yeah, I'm down to about a minute here. So I thank you very much for tuning in, listening in. Hopefully this was useful. If this has tweaked some questions, obviously in about a minute I'm away, but you should have your own advisors chat with you about this. Chart with your financial planner, talk to your accountant, talk to your lawyer. They know about this, they know how to set it up, and based on your personal situation, we'll be able to give you an idea if this makes sense for you now or maybe later or something that you may want to become aware of down the road. So I will leave it at that, and I will throw it back to Noel. It was a pleasure doing this. Thank you very much, and we'll see you soon. Thank you. Bye-bye.